I'm Larry Walther. This is principlesofaccounting.com, Chapter 10, and in this module I simply want to point out some differences between depreciation for tax versus financial accounting purposes, and also mention some accounting considerations that relate to equipment leases that are quite popular. So first of all, on the tax code, recognize that tax and financial accounting methods are not always the same. Accounting rules are designed to measure economic activity and require proper schemes for assigning revenues and costs to time periods. Tax codes, on the other hand, often change to meet the revenue or social needs of a particular government. And so with that in mind, governments may try to stimulate economic activity or investment by providing incentives to make capital investments and allow the recovery of the cost of those investments through rapid depreciation methods that would be faster than would be appropriate for financial accounting purposes. The depreciation causes a decrease in taxable income and therefore reduces a company's tax obligation and may provide them incentive to make an investment. Depreciation under the tax code is oftentimes referred to as MACRS, or the Modified Accelerated Cost Recovery System. It generally permits more rapid recovery of asset than GAAP-based approaches. Tax codes also tend to stipulate the useful life of an asset rather than leaving it to the imagination of the taxpayer. And those are very liberal, typically short lives relative to the actual life of a particular asset. Let's move on to equipment leases. With a lease agreement, the lessee pays money to the lessor for the right to use an asset. In the legal context, the lessor is the owner of the asset and the lessee is merely using the property in exchange for a payment. However, in an accounting context, we tend to look at the economic substance of the transaction to try to find the appropriate accounting. And what we find is that some leases are more like asset purchases. We call those capital leases. The risk and rewards of ownership are effectively transferred to the lessee. The lessee accounts for the leased asset as though it had purchased the asset. That means that within property, plant, and equipment, it will record an asset, debit an asset account for the leased asset, and on the liability side, record an obligation under capital lease reflecting the present value of the stream of payments that's committed to under the lease agreement. In this sense, then, the accounting for a capital lease from the lessee's perspective is much like accounting for the purchase of an asset on credit. In the USA, to determine whether we have a capital lease or not, it's a criteria, bright line driven type approach. If ownership transfers by the end of the lease term, or if the present value of the minimum lease payments is greater than or equal to 90% of the fair value of the property, or if the lease term is greater than or equal to 75% of the life of the asset, or if there's some other bargain purchase option provision in the lease that effectively gives rise to an expectation that the lessee is going to acquire ownership of the asset. If any one of those are present, we generally regard that we have a capital lease. If not, we consider the lease to be an operating lease. Operating leases do not meet one of the conditions. The payments are merely recorded as rent expense. This is really no different than you were exposed to in, say, Chapter 3 in the book, where you learned about prepaid rent and rent expense accounting, just accrual accounting concepts. The underlying asset continues to be reported on the lessor's books, not the lessee's books. Recognize that international accounting standards take an approach that provides far less specific guidance and looks primarily to the accounts to determine the economic substance of the transaction without being driven by specific criteria. Finally, I would say that these rules are very likely to change in the near future, both within the United States and internationally. The thought is that perhaps leases should be recorded at the present value of the committed cash flow, regardless of whether it's an operating lease or a capital lease. So this area may see significant change in the years to come.